Now, it's no secret that ULTY, the YieldMax Ultra Option Income Strategy ETF, has become one of the most talked about income ETFs on the market. Not only does it pay a very high distribution rate of around 80%, but it pays weekly income from a portfolio of covered call strategies, each on a US listed security, from about 15 to 30 securities. And while many people have been concerned with the share price going down about 9% in the past month, there are some strategies to help mitigate some of this depreciation. And in this video, we're going to go over an options strategy that you can implement right now to help mitigate some of that risk and help cushion your portfolio a bit, because it is a great way to hedge your portfolio by selling these call options. But first, let's go into a quick refresher. ULTY's portfolio, which we mentioned is going to be 15 to 30 very volatile stocks. And as we can see, we have a lot of underlyings here. Some of them you probably haven't even heard of, like OKLO or even Rocket Lab. But we do have other underlyings such as Robinhood Markets and Coinbase that many people are familiar with. So very volatile stocks, because we want the most volatile stocks in order to collect the most option premium as possible, which is going to give us this 80% distribution rate. But because we have very volatile underlyings, this could make the ETF itself volatile as well. If any of these stocks in the portfolio end up doing pretty poorly, or all of them doing pretty poorly in the bear market especially, they're going to drop pretty hard, which in turn is going to have an effect on our price for ULTY, which we do want to mention. We have now hit $3 billion assets under management. So a lot of people are buying this ETF, and we have almost 29 million volume as of Friday. But as many of you are familiar with, as it holds these underlyings, it sells covered calls. And what we're going to do is going to be a strategy similar to selling covered calls, but a little bit different to help cushion downfalls. Now let's head over to your favorite brokerage. In this case, I'm going to use Robinhood. This is where I keep all of my income focused ETFs. I have about 1,500 shares of ULTY. I am down a little bit on the share price. I'm not too worried because I've collected thousands in distributions so far, because I've been holding for quite a few months. So even though it says it's down 5-6% total return on Robinhood, that's for the share price alone. It's not counting any of the distributions that I've received, which I'm positive total return. So let's head over to the options chain. In this case, you want to go onto the sell and make sure you're on call, because we're going to be selling covered calls. In order to sell covered calls, you have to have at least 100 shares of the underlying to sell a call. And ULTY is pretty perfect for this because it's a very cheap share price, $5.68. So in order to sell one covered call, you're going to only need $568. So what we want to do is change the expiration date, maybe to a month out. So in this case, I'm going to choose the September 26th expiration date. And what we're going to do is we're going to scroll down to the options chain, and we're going to see something like the $5 call option right here for $55. Now it does look like the bid and ask is moving quite a bit. The mark is about $6.25, so we'll just call it about $60 in premium. You set the limit order to 60, and you're going to get $60 in premium for selling a $5 covered call. And what this is going to do is you're basically going to have to sell ULTY shares at $5 each by expiration if ULTY is above your strike price, in this case $5, which most likely you're going to get assigned on this covered call at expiration unless ULTY drops below $5. And we're going to be doing this because we're going to be collecting the most premium possible when we're selling it in the money call option. And it's going to give you an almost guaranteed assignment if you're holding to expiration. Now, if you were selling an out of the money covered call, which ULTY usually does, it's usually between at the money or a higher strike price on the underlyings, that's going to allow for some upside potential. And it's going to be a little bit smaller premiums, but your upside is still going to be capped at whatever strike price you choose. But if we're selling in the money covered call on ULTY, it means you're effectively pre-selling your shares at a discount in exchange for maximum upfront income. And the best thing about this strategy, especially choosing a little bit further of a date of expiration, you're going to be collecting weekly income. And we're going to go over some of the risks with this strategy later in this video, but basically you can sell this call and until expiration date, in this case 28 days, which is going to give us about 4 weeks of distributions. Then we're going to be collecting double the income. We're collecting the premium from selling the option as well as the weekly distributions for 4 weeks. Now this is going to be a little bit better than just holding ULTY, which pays out on a weekly basis, because you're getting some protection by, as we mentioned earlier, you're pre-selling some of your shares at a discount and then receiving premium for doing so. And I've compiled some of the math. So say ULTY's current share price is $5.68. If you buy 100 shares to sell one covered call, of course, if you have a larger portfolio, you can sell multiple covered calls. But for this case, it's going to cost you $568, a very low entry barrier. And if you sell the $5 call option expiring in a month for $60 of premium, then that goes directly to your account. And this is all to help lower your cost basis. But of course, if you just simply held shares of ULTY and ULTY does perform pretty well, you will make more money because you're not having to give up your shares at $5 each. And let's assume that ULTY is going to pay out 9 cents for the next 4 weeks. We're going to collect 36 cents in a month per share, which is actually going to be $36 because we're holding 100 shares for one covered call. Now, here are the scenarios. So if ULTY stays above $5, then you have to sell your shares at expiration for $5 each, which is going to be on paper a net loss because you're going to be selling your shares for $500 and we bought ULTY at $5.68. So we paid $568, which is going to be a negative $68 loss. And this is going to occur if ULTY, whatever the price is above $5, because at expiration, you're going to get a sign on the covered call and your shares are going to be called away. So ULTY could be at $10 per share. You have to sell your shares at $5 each. You're missing all that upside potential. And if ULTY is at $5 and say 10 cents, then it's going to be the same negative $68 loss. But in return for this, you're going to be collecting $96 in premium, because remember, we're collecting $60 in premium for selling the call option, as well as $36 in weekly distributions for the month. So in total, your net profit is really $28. Now, if you didn't do this strategy at all, then you would be, of course, net profit of $36. But what we're doing is we're adding a layer of cushion because ULTY can drop all the way down to $5.05, which is about 60 cents under the current share price, and you will still be net positive $28. So that is kind of the takeaway for selling an in-the-money covered call like this. Now, this is probably the worst case scenario. If ULTY drops below $5, then our call option is now out of the money and we will not get our shares called away. But of course, there's going to be more downside risk because our shares are now worth less than, of course, $5. But we are going to have a little bit of cushion due to collecting the option premium of $60. So if you have ULTY, you sell an in-the-money covered call, but ULTY drops below $5 to say $4.50, you're going to be a little bit better off than the person who has just held 100 shares of ULTY, because they're not collecting this additional $60 of income. And I think this strategy is a perfect strategy for a lot of people because we're all focused on income at the moment. Expenses are really high, where we want as much income as possible, not only to supplement additional expenses, but to just have more disposable income as well. And then we do have to consider the risks, as we mentioned. So we mentioned we will be collecting weekly distributions every single week. In this case, you're going to have 4 weeks of distributions, 9 cents each. But there is the possibility of early assignment because the person who has the call option that you sold it to, they could assign that at any moment. They can exercise their contracts and collect the shares. Now, of course, this is a very low probability, but it is a probability. So in that case, you may not receive the full distributions. But in my opinion, I think that you will at least collect 1 or 2 of these weekly distributions before early assignment. And that is going to eat away at some of your profit, which is part of the risk. And especially since ULTY has high distributions, a lot of people who have these in-the-money call options may want to exercise their contracts early. So you're going to lose your ULTY shares and miss that week's payout. And of course, the other risk is you're going to be missing out on some of the upside potential. So if you are bullish on ULTY, you think it's going to recover all the way up to $6, $6.50, you don't really want to sell a covered call in the money. Maybe you want to sell one further out of the money, but you're not going to receive much premium for that. Because if you do sell a covered call and ULTY goes to, an extreme example, $10 per share, you're going to be missing out on all that juicy gains. But this strategy is for people who want to maximize their income and prioritizes yield over growth, which most people are if they are buying ULTY. And some alternatives could be buying or selling. Let's head down to the options chain and at the money strike, which in this case would be $5.50. Or you could even sell a cash secured put to try to get ULTY at a cheaper price, but you're not going to receive any of those weekly distributions. So in my opinion, I think that selling an in the money covered call, maybe like a $5 strike, is going to be a pretty good option to do on some of your shares to help hedge your portfolio. Because remember, if you sell a $5 strike and ULTY drops 50 cents, nothing is really going to happen until ULTY drops below, if it drops below $5. But overall, ULTY is already a high yield ETF thanks to its own covered call strategy. But by selling in the money covered calls on top of your ULTY shares, you can supercharge your income and collecting both the funds distributions and your own option premiums. And this approach is going to rapidly lower your cost basis and can deliver double stacked income. But the trade-off is the risk of early assignment, capped upside, and full exposure if ULTY free falls. So let me know down in the comments below what you're doing to hedge your portfolios, especially in this environment of uncertainty, and if you want to utilize this option strategy on top of ULTY.